China's economy showed significant growth in the first quarter of the year, while other global economies faced a slowdown in growth as central banks increased rates to combat inflation. According to the National Bureau of Statistics, China's gross domestic product, GDP, increased by 4.5% in the first quarter, marking the fastest growth rate since the same period of the previous year. The growth rate was also better than the 4% forecast in a Reuters poll, indicating that China's economy is rebounding quicker than expected. The global economy has been closely observing China's economic growth as the country gradually eases its strict COVID-19 measures. The latest figures indicate that retail sales in China surged by 10.6% in March, with online sales of physical goods experiencing a notable increase. This positive trend in the retail industry points towards the Chinese economy's ongoing recovery from the pandemic's impact. In addition to retail sales, industrial output also demonstrated growth, albeit slightly lower than the predicted rate of 4% as forecast by Reuters. The data revealed that the economy grew by 3.9%, which is still an impressive feat, considering the global economic slowdown caused by the pandemic. This growth rate suggests that the manufacturing sector, which was severely affected by the pandemic, is gradually making a comeback, which is a significant positive indicator. However, while the overall economic data appears to be promising, year-to-date fixed asset investment was weaker than expected. The growth rate of fixed asset investment in China was only 5.1%, lower than analysts' predictions. This slowdown was mainly due to a decline in growth rates in infrastructure and manufacturing investment. Despite this, the Chinese government continues to invest in fixed assets, which suggests that they are optimistic about the future growth potential of these sectors. Furthermore, real estate investment has continued to decline. This is significant, considering that the real estate industry is one of the major contributors to China's GDP. The data indicates that the industry has not been able to sustain the growth levels it experienced before the pandemic. This could have significant implications for the Chinese economy, as a thriving real estate industry is critical to overall economic growth. In summary, the latest economic data from China highlights that the country is on the path to recovery from the pandemic's impact. However, there are still areas of concern, such as weaker than expected fixed asset investment growth and a decline in the real estate industry. The Chinese government's decision to invest in these sectors indicates that they are optimistic about their future growth potential. Although China's economy experienced slower growth in 2022, Goldman Sachs maintains a positive outlook for the country's full-year GDP. The investment bank states that China's growth of 4.5% in the first quarter supports their forecast for the economy to grow by 6% in 2023. Inflation has been a concern for China's central bank, but consumer inflation hit an 18-month low earlier this month. While analysts do not expect the central bank's benchmark lending rate to change, some believe the People's Bank of China could marginally reduce its one-year loan prime rate if inflation slows further. Although China's economic performance has been strong, there are concerns that the recovery may take longer than expected. However, there is optimism that the Chinese government will continue to release additional stimulus to bolster the economy. Experts predict that the government will focus on infrastructure investments, such as building metro lines and increasing the number of 5G towers, as these are already part of the plan for this year. Economists have warned that external demand may pose a challenge to China's growth, but some remain hopeful that the government's pro-growth stance will help the country achieve its modest growth target of around 5% in 2023. How do you feel about this? Make sure to leave your opinions in the comments. Like this video if you enjoyed it and subscribe.